You know, for about 2 decades, one company basically owned the digital checkout button. That little blue tab, the one that lets you buy stuff online without ever having to find your wallet? Yeah, I'm talking about PayPal. It wasn't just another company. For the longest time, it was the gold standard for trust and convenience online.
And yet, look at this. Since its peak back in 2021, the stock has been absolutely demolished, down a staggering 75%. I mean, that's the kind of crash you expect from a company that's about to go out of business. But here's the wild part, the paradox. During that exact same time, its operating profit has actually gone up by over 30%. It's literally making more money than ever, but the market is treating it like it's yesterday's news.
So what on earth is happening here? That is the central mystery we are going to unpack right now. Why has the undisputed king of digital payments been so viciously punished by Wall Street? Well, to figure that out, we actually have to go back to the very beginning.
To really understand PayPal's massive fall from grace, you first have to appreciate its incredible rise and how it managed to build a whole empire on something as simple and as powerful as trust. The origin story is pure Silicon Valley legend. You've probably heard of them, the PayPal Mafia. We're talking about a founding team that included people like Elon Musk and Peter Thiel. After cashing out of PayPal, this crew went on to create or fund Tesla, SpaceX, YouTube, LinkedIn, the list goes on. I mean, they didn't just build a company, they pretty much built the modern internet. The company's huge break came really early on. In 2002, eBay swooped in and bought PayPal, making it the go-to trusted payment method on the biggest auction site in the world. And that was like strapping a rocket to it. It became the default middleman, the safe way to pay when the internet still felt a little like the Wild West. And by 2021, it had soared to a mind-blowing valuation of over $350 billion. And this right here shows you what their secret sauce was: pure trust. A study actually found that 60% of people trust PayPal with their payment details even more than they trust their own bank. Think about that. That trust, plus hundreds of millions of users, created this incredibly powerful network effect. The more people that used PayPal, the more stores had to offer it. For years, they seemed completely untouchable.
But then, right when PayPal was standing on top of the mountain, the whole story just shattered. The market started seeing these deep cracks in its foundation, and man, the reaction was just brutal.
Okay, so to really get the problem, you have to understand one single crucial number: the take rate. It's just the little commission fee, the percentage PayPal skims off the top of every single transaction. You can think of it as a direct measure of their power. The higher the take rate, the stronger their monopoly.
And that power, it has just fallen off a cliff. A decade ago, PayPal's take rate was a healthy 3.4%. Today, as you can see, it's been slashed in half, down to around 1.7%. And this wasn't really a choice. They were forced to drop their prices because new, slick competitors like Stripe and Adyen came in and offered merchants better deals. While Apple Pay and Google Pay made checking out on your phone completely seamless, the moat was gone.
And then came the 1-2 punch. After years and years of just explosive growth, hitting over 430 million active accounts, it just stopped. The number of new people signing up completely flatlined. It was like the music just stopped playing. And for a company whose entire story was built on unstoppable growth, that was a huge red flag for investors.
And here's why that stalled growth is so scary for them. Take a look. Over 90% of PayPal's entire revenue comes from those little transaction fees. So think about it. If your user base isn't growing anymore and the fee you're making from each user is shrinking, well, your core business model is in serious trouble.
So with its main engine sputtering, the huge question is, what's next? Well, PayPal isn't just sitting around. The company has a new CEO at the helm and a brand new game plan they hope will let them fight for their spot in a world they don't really dominate anymore.
Their whole turnaround strategy really boils down to 3 big moves. First, get more money out of the massive user base they already have. Second, push into new, more profitable services. And third, try to build a totally new kind of global payments network.
And this isn't just corporate speak. They're actually making moves. They're getting way more aggressive about making money from Venmo's 90 million users. They're leaning into their buy now, pay later service, which is growing fast, and they're even making some really interesting bets on the future, like partnering with AI giants for something called agentic commerce, basically a future where your personal AI assistant does the shopping for you, and PayPal wants to be the payment system sitting right underneath it all. And they're not just talking a big game, they're putting a number on it.
Despite all the challenges, management is actually forecasting at least 15% growth in earnings per share for 2025. That's them signaling to Wall Street, hey, we think this plan is actually going to work.
Which brings us right to the final multi-billion-dollar question for everyone watching this company. With the stock beaten down this far, is PayPal a massive, once-in-a-generation opportunity, or is it a trap?
If you're bullish on PayPal, this is your whole argument right here. Just look at these numbers. PayPal is trading at a price-to-earnings ratio of around 12, when the average for its industry is way up at 22. It's kicking off a free cash flow yield of around 9%. Basically, by all the classic Wall Street yardsticks, this thing looks like it's sitting on the bargain rack.
So it really boils down to two totally different stories you could tell about PayPal right now. The bull case says this is a fallen giant, still wildly profitable, that's just been unfairly punished by a panicked market. The bear case says no. This is an ex-monopoly that's caught in a slow, terminal decline, and it's just going to get squeezed by better, faster competitors forever.
And this is the ultimate fear here. It's what investors call a value trap. That's a stock that looks incredibly cheap on paper. It looks like a total bargain, but it's actually cheap for a very good reason. Its best days are already in the rearview mirror, and they're never coming back.
So at the end of the day, it all boils down to this. Has the market completely overreacted, creating a historic buying opportunity in a company that's still a cash machine? Or has the market correctly sniffed out the painful new reality for a giant that, for the first time in its life, has to actually compete? That is the paradox at the very heart of PayPal today.